Today, we are going to demystify the core concepts of national income. And I promise, by the end of this, you'll see it's actually way simpler than it sounds. So, we've all got a pretty good idea of what GDP is, right? But the second someone throws out GNP or NDP or NNP, or they start talking about market price versus factor cost, it can get confusing fast. But what if I told you there's a really simple trick to understanding all of it? Well, there is. You see, the key is to stop thinking of these as totally different concepts. Just imagine you have one single photo. You can put a black and white filter on it, a sepia one, or maybe make it super vibrant. The original image doesn't change, just the way you're looking at it. That's exactly what we're doing here with national income. To unlock this whole thing, we just need to understand 3 simple switches we can flip. That's it. First up, domestic versus national. Second, gross versus net. And the third one, market price versus factor cost. Once you get these 3 down, you've pretty much cracked the entire system. So let's start with that first one. All right, let's get into our first switch. This one really just boils down to one simple question. Are we measuring what's made inside a country's borders or what's made by that country's people, no matter where they are? Here's how it breaks down. Domestic is all about location. Think of it like a geographical box. Anything produced within India's borders, doesn't matter if it's by an Indian citizen or a foreign company, it all counts towards its domestic product. Now, national is all about citizenship. It's the total value produced by all Indians, whether they happen to be in Mumbai or Melbourne. So how do we get from domestic to national? Well, the bridge between them is something called net factor income from abroad, or NFIA for short. You just add this to your domestic product. The easiest way to think about it is as a net flow of money. It's all the income your citizens earn overseas minus the income that foreigners earn inside your country. Let's make this real. When an Indian cricketer, say Virat Kohli, earns money playing in England, that's income for an Indian citizen, right? So it gets added to India's national income. On the flip side, when a Korean company like Samsung makes a profit from its factory in India, that money is eventually going back to Korea. So it gets subtracted from India's national income. Simple as that. Okay, on to our second switch. And trust me, this one is really, really simple. It's all about accounting for the natural wear and tear on the stuff we use to produce things. You know, like the machinery in a factory. Think of it this way. Gross is the big, shiny number, the total value created, period. But net is what's left after you account for the fact that your tools and machines got a little bit worn out in the process. Economists have a word for this, depreciation. So gross is the grand total, while net is the slightly smaller and you could argue more realistic number. The formula for this could not be easier. To get from any gross figure to its net version, you just subtract depreciation. And hey, here's a quick tip. If you're reading a textbook and you see the term consumption of fixed capital, don't panic. It's just a fancy way of saying depreciation. Let's use a super simple example. A factory produces goods worth 100 crore. Awesome. But over the year, its machinery has worn down by a value of 10 crore. So while the gross value is that big 100 crore number, the net value that was actually added to the economy is 90 crore. It's really that straightforward. And now for our third and final switch. This one is all about the gap between the price you see on a product in a store and what it actually cost the producer to make it in the first place. Market price is easy. It's the price on the tag. It's what you and I pay. But that price is often influenced by the government, right? They add taxes that make it go up, or they give subsidies that make it go down. Factor cost, on the other hand, is the producer's side of the story. It's what it costs them to get all the factors of production, land, labor, capital, to actually create that product. So the bridge between these two prices is something called Net Indirect Taxes, or NIT. It's basically just the government's total impact. All the indirect taxes it slaps on, minus any subsidies it gives out. So to go from the market price back to the original factor cost, you just subtract this NIT. Let's follow a biscuit on its journey from the factory to the store. Okay, let's say it costs 8 rupees to make. That's our factor cost. Then the government adds a 3 rupee tax. But the government also gives a 1 rupee subsidy to the producer to help out. So the final price you see on the shelf, the market price, is 8 plus that 3 rupee tax minus the 1 rupee subsidy, which gets us to 10 rupees. So now we have our 3 switches. And this is the really cool part. We can combine them. With these 3 simple rules, we can take any one of these national income figures and turn it into any other one. It's like we have a master key. This table here puts it all together.
You can literally start anywhere on this chart and get to anywhere else. For example, want to go from gross to net? Easy, just subtract depreciation. Want to go from domestic to national? You got it, just add NFIA. And to get from market price to factor cost, you just subtract net indirect taxes. It's a simple, repeatable process every time.
Now, here's a crucial tip, especially if you have exams coming up. When economists just say national income without any other details, they are almost always talking about this one specific measure, net national product at factor cost, or NNPFC. And why this one? Well, because it represents what the nation's citizens actually earned after you account for the wear and tear on their equipment and before all the distortions from government taxes and subsidies. Now, let's wrap this all up by turning this knowledge into a practical game plan that you can actually use to ace those exams. Okay, 3 quick tips to make this stuff stick. First, when you get a calculation problem, always write out the formula before you plug in the numbers. It'll save you from making silly mistakes. Second, learn to decode the language. Gross domestic product at factor cost is just a long way of saying GDPFC. And finally, you know it, practice. Just run through these conversions a few times and they'll become second nature. So let's end with a final thought. We've learned how to calculate all these different figures, all these different filters for our photo. But which one do you think tells the truest story of a country's economic health and the income of its people? Is it the big gross figure or the more realistic net one? The domestic product or the national one? That's something to think about.